current tax. So let's define and say is the amount of income tax payable is the amount of income tax payable, amount of income tax payable or recoverable, put in brackets, or recoverable on taxable profit, on taxable profit, on taxable profit for the current accounting period, for the current accounting period, for the current accounting period. So if you have 1 million to pay for that one financial year, we call it the current tax. We call it the current tax. And then, so how do we recognize this current tax? How do we recognize this current tax? How do we recognize this current tax? So recognition, when it comes to the recognition of this current tax, because it is there for the current period, then you will have to do what? You debit the expense account, which is basically the P&L. The expense account, which is basically the P&L. And then if you have not paid this current tax, it is a liability. If you have not paid, it is a liability. So you accrued. So you credit accrual, which is basically the tax liability. The tax liability. So this is how we account for the current tax. This is how we account for the current tax. That is the journal entry for the current tax. What about if you pay? You debit the accrual account, you credit the bank. So those are the journal entries for current account. Let's have another term called the deferred tax. The deferred tax. From the word deferred. Deferred tax. So you are a good example is that you are to pay 1 million. You are to pay 1 million in that current financial year. And then you say, I will not pay. I don't have cash to pay this tax. I will pay in the subsequent years. So you are deferring this income tax into the next financial year. It's you are shifting that obligation of paying tax to another period. You don't want to pay. It's not that we may escape that tax, but we may push forward. So you say a tax due to deferred tax arise due to the temporary difference. Before even we write that narration, you can say it arises due to future tax payable or refundable. So it arises due to the future tax payable or refundable. Future tax payable or refundable. Then put another narration and say it also arises due to the temporary difference. It also arises due to temporary recurring amount. Between the carrying amount and the tax base between the carrying amount and tax base, between the carrying amount and the tax base, between the carrying amount and the tax base, between the carrying amount and the tax base. So we have this term. Remember, this one we have generalized that deferred tax. So we have the deferred tax assets and the deferred tax liability. So we have two forms of deferred tax. We have two forms of the deferred tax. That's the deferred tax liability and the deferred tax assets. And the deferred tax asset. So we can have the two. So you can say this difference creates, put semicolon. Number one is deferred tax liability. Deferred tax liability in bracket DTL. Number two is the deferred tax asset. Deferred tax assets in bracket DTA. Deferred tax asset in bracket DTA. So this one, you put a small event. There's no need to write a lot of literature. Say future tax payable. Future tax payable. This one is future tax refundable. Future tax refundable, and another one is future tax payable. Tax payable. So you have to understand this one, because even in the practical field, this Mambona accounting for the deferred tax, it is so challenging to so many accountants. Why? Because they don't understand, they don't differentiate between an asset and liability. So for example, you are charging what do we call the depreciation? You provide the depreciation for 1,000. You provide the depreciation for 1,000 in your company or the company you are working, and then that tax month will come and say the depreciation is, or the allowance for depreciation is this one to really 120. When you say 120, no, let's say no, this one, let's say 80. So 80. You provide 100 as an expense in your P&L. You have debited the P&L. What happened to the profit? You have reduced the taxable profit. And then this 100 is not as per the prescribed rate of the capital allowance. Remember, depreciation, we grant capital allowance instead of depreciation when it comes to the taxation. So the taxman has granted you a capital allowance of 80, but you have charged 100. So which means there is an overstatement of 20. So you have overstated your expenditure by 20, which it has lowered the taxable amount. So if you do the adjustment, then this 20 will reduce your will increase your what do we call the taxable profit. So if you increase the taxable profit, it means you'll have to pay this 20 in future. That's why we call it the future tax payable. The future tax payable, and it is an opposite. You have provided a depreciation of 80, but the capital allowance is 100. So in this case, the taxman is owing you 20. That's why it is called the future tax refundable. The future tax refundable. So you have to understand that concept. So we will have the format of the P&L. the format of the fee. And I don't want to assume that unafanya tax. Let me say that you did tax 5 years ago. So how do we get the taxable profit? For those who are doing tax, how do we get the taxable profit? How do we get the taxable profit? Oh, yeah. You take the reported profit. You take the reported profit. You add back, expenses. When we talk of disallowable expenses, these are expenses which it is not relating to the generation of business income. It is not relating to the generation of a business income. A good example, you pay tax, VAT. Does that VAT relate to the generation of a business income? It is not. That's why we regard all the taxes as a disallowable expenses. Then, so that I think you can allow me to change the net. I think that now is better. So say it so that you can arrive at taxable profit. So from this now, for you to get the tax, you take the 30%, the 30% of that, take the 30%. So let's have an illustration. Let's have an illustration. Let's have an illustration. So I don't know whether you have this question. It was a good question here. December 2012. Do we have December 2012? Do we have December 2012? Mokona December 2012. So let me take a picture. So it is for equipped agencies. Equipped agencies. Sijui kama ni clear, but it is a, I think you can see it. So check in the group. So it's called the agency, Equipped Agency Limited. Agency Limited. Jake, Victor saying which group? We think, let me tell Mwalimu to share on the group. I think it is a group of FR group. So check. So I hope everyone ameshapata. So we have been told, or you can write, maybe I read, but I will not write the figures. Not so we have been told the Equip Agency Limited purchased an equipment of 400 million on 1st July 2018. On 1st July 2018. Good. The depreciation on equipment is provided on a straight line basis at the rate of 25% per annum. And then we have been told during the 4 years from 1st July 2008 to 30th June 2012, the profit after tax and allowed wear and tear charges for the tax purpose were as follows. So we have been given the period for the 4 periods and then the profit before tax, and then I think there is should be the profit after tax. Yes, I think someone tried to adjust before tax, but it should be a profit after tax. And then we have allowable wear and tear charges with the different rates. We have been told the corporate tax rate is 30%. The corporate tax rate is 30%. Required number 1, the taxable profit. Number 2, the temporary difference and the deferred tax account and the deferred tax account and the deferred tax account. So for us to arrive at the taxable profit, we will use this format. We will use this format. So take the reported profit for this is 4 years. So we can arrange in this way. Years 20, which format can we use? Years iende hivyo machini. So we can have 209. Another one is 2010, 2011, and 2012. The reported profit or the profit after tax, we call it that is it is good. Profit before tax, that is okay. So I've seen there's a changes there. That is profit before tax. Profit before tax. We can cut the zeros, or you like using a lot of zeros. So let's cut 3 zeros. Cut 3 zeros. So we have the first one is 800. I can see 900. And then 950. And then we have 850. We said we add back disallowable expense. We add back disallowable expense. So in our case, what is our disallowable expense here? Disallowable expense is depreciation. Remember depreciation, we use the standardized one, which is the capital allowance, that is wear and tear. We don't use depreciation. The reason why we don't recognize depreciation as allowable expense is that every company, they use their own rate of depreciation. So the Kenya Revenue Authority has to come up with a standardized one. So now we get depreciation. Depreciation, you take 4 million, which times the rate 25%, because we have been told on a straight line basis. So 25% of 4 million. 25% of 4 million. Kona calculator ama unatumia simu? Buy your calculator. Which is a million. This is 1 million. So nimeikata 3 zeros. So I will say less. No, it has already been subtracted here. It has already been subtracted here because this one is the profit before tax. So we'll have to add back. So we add back depreciation, which it is constant throughout the year, 1,000. And then less the allowable expenses, less the capital allowance. So the capital allowance now, we are charging 40% on the first year. Remember the capital allowance, they use the reducing balance method. They use the reducing balance method. That's why for year 1, we are charging 40%. For year 2, 30%. Year 3, 20% and 10%, because they use the reducing balance method. So for year 1, you will take 40% of 4 million, 40% of 4 million, which remember we have 3 zeros, so we can use 4,000. So 40% of 4,000, 1,600. So subtract this. And then number 2 is 30% of 4,000, 20% of 4,000, 10% of 4,000. This one is 1,200. This one is 800. And this one is 400. So let's get the taxable profit. Let's get the taxable profit. I hope you have written this so that you don't forget where did we get these values. So it is the rate times the cost of that. Is it the cost of yes, the cost of an equipment times the cost of an equipment. So I can start. So let's get to the taxable profit. You can start with the 2012 850 plus 1,000 minus 400. So the taxable profit here is 1,450. 1,450. The next one is 950 minus plus 1,000 minus 800. This one is 1,150. 900 plus 1,000 minus 1,200. This one is 700. And then 1,800 minus 600. 1,600. That is 1,200. This is 200. We have been asked the taxable profit. So this is our taxable profit. This is our taxable profit. So that is the first part, the taxable profit. This is Roman 1. Roman 2. Roman 2, you have been asked the temporary difference. The temporary difference. So what is that temporary difference? What is the temporary difference? It is the difference. It is the difference. It is the difference between the carrying amount and tax base. And tax base. So you can say DT equivalent to the carrying amount, which is CA minus the tax base. So for you to get the temporary difference, you take the CA minus the temporary or the tax base. The tax base. So the carrying amount is the net book value or the amount which it has been recognized by the accountant. And then the tax base is the amount provided by the tax law. The amount provided by the tax law. So any difference will arise in temporary difference. And you remember, we said temporary difference, we have two, either the deferred tax liability or the deferred tax asset So it will appear in those two forms. Now, can we look at the second part? So I hope kila mtu ameshaandika mpaka hapo. Sitaki useme nimekuwa too fast. Victor, umeshaandika? Edwin, Bryant, Caroline. So make sure that you write and you ask the question. Mali uelewi. So we can arrange this in which format? Tuko na 4 years, tuta-arrange in which format? We can say the nature and then years, the carrying amount, CA, tax base. When you get that, we get the temporary difference. And then 30%, that it can be either TL or TA. That is the deferred tax liability or the deferred tax asset or the deferred tax asset. So the first, actually, you don't need even the nature because we all know it is all about depreciation. So 209. What was the value of the depreciation? The value of the depreciation is constant throughout the period, which is for accounting purpose. Remember, this one is for the accounting. This one is for the accounting, and this one is for the tax. So for accounting, they charge 1,000. For tax, for the first year, they charge 1,600. So the accountant has underestimated the depreciation, or they provided the less depreciation. So if you provide the less depreciation, the difference of this minus this, which is coming to 600, which is our temporary difference, is it an asset or a liability? Is it an asset or a liability? Let me see. Brian, is it an asset or a liability?
Sorry, repeat the question.
This difference between this 1,000 of the carrying amount and the tax base of 1,600, which is giving us a difference of 600. Is it a deferred tax liability or a deferred tax asset?
A liability.
It is a liability, since you have what?